Hello, AP teachers, and welcome to the beginning of AP Macroeconomics Unit 3. Good work, we've made it this far. So the first big thing we introduce in Unit 3, which is the unit that basically covers economic indicators, so GDP, inflation, unemployment. But before we can get to that stuff, we need to introduce kind of an oversimplification of the macroeconomy to the kids so they can kind of visually understand the flow of money and the flow of goods and services in the macroeconomy. So this model that we introduced first is the circular flow diagram. Now I'll give you a little bit of warning. This one is going to be a fairly lengthy video. The circular flow diagram is fairly complicated, and it's something that I tend to spend either 2 or 3 48-minute classes on. So this is something that's going to take some time to work with the kids on, but it's certainly important to spend the time doing this. Don't try to rush it into one class period because understanding how the circular flow diagram works helps the kids to process how GDP works, and actually being able to visually see the flow of GDP through the economy, I think conceptually is really helpful. So to begin our discussion of the circular flow diagram, what we have here is you see 5 boxes and then a circle. We'll get to the circle at the very end of this. Don't worry about that for right now. What the 5 boxes of the circular flow diagram essentially represent is we're trying to take all of the economic activity across the entire macroeconomy and simplify it down and categorize it based on actually what that activity is and what purpose it serves in the economy. So we've broken this down into the 5 major sectors of the economy, and we're defining those sectors as what purpose they serve to the broader economy as a whole. So let's spend a little bit of time talking about who each of these sectors are, give some examples of that stuff, and talk about what it is they do. So the first big sector, and probably the easiest one for the students to understand because it's basically them, is the top box up there. This is going to represent households. So households essentially have a dual function in the circular flow diagram. Their primary purpose is to be consumers. So the big job of households is to buy the products the economy is producing, keeping in mind that if households stop buying, producers stop producing, and this is how recessions get started. But in addition to being consumers who are responsible for consuming all of the products created in the macroeconomy, households also provide and own the factors of production, which is where they get the money to make those purchases from. One good thing that I like to talk about the kids with here is to talk about why we measure consumption here as households rather than as individual consumers. The thing you may want to stress to them really quickly is that when we make decisions about what to purchase, we don't make those decisions in a vacuum. I'll usually pick a kid in class and be like, how many groceries have you bought this year? And hopefully they say none or very, very few. And this kind of gives you leeway to talk about how when we make our individual purchasing decisions, it's not based on just what we need or what's good for us, but it's also impacted by what the rest of our household is doing. So you may want to point out we treat households as one unit of consumption here rather than individuals, because what the individual does is influenced by what everybody else in their household is doing. We're not all individually going to the grocery store to buy the groceries. We want usually one person in the household is doing all of the grocery purchasing for the entire house, and that's okay. We want to make sure that we take that into account. To the left of households is another one the kids find relatively easy to understand, and those are going to be your product markets. These are basically the stores. If the kids are going somewhere and purchasing final goods and services at, say, Foot Locker or Hot Topic or wherever it is they're buying it, the place where the consumer goes to actually purchase a product is what's known as the product market. The product markets, and this is an important thing to stress, don't actually produce products in this economy. They're not producers, they're not firms. The product market is responsible for taking products that are produced elsewhere and making them available to the consumer at a marked up price. So product markets produce a service, but they do not produce goods. I'll usually use, shoes as an example, and I'll ask the kids, do you want to fly to Thailand to get your pair of Nikes? They'll say no, they don't want to fly all the way to Thailand to get shoes. And so we'll just describe that a company like Foot Locker, their primary function here is to send somebody to Thailand, get those shoes, ship them to the United States, and put them on the shelf at the mall so that consumers have easy access. They're providing a service here. That service has value, and for it, they are marking up the price of those goods and services. At the bottom of our graph, we have firms. Now, some of the circular flow diagrams in some textbooks label this box businesses. I'm going to stress, do not label this box businesses, even if the circular flow diagram in your textbook does. The reason being that while firms are businesses, product markets and factor markets are also businesses, and it really confuses the kids if you try to label this businesses. So a firm is a business, but it's a very specific type of business. In this case, the role of firms in the circular flow diagram is to take raw materials and turn them into finished goods and services. So it is the firm that is actually producing the products the kids want to buy. So in our previous example, the firm would be the Nike factory in Thailand. They're the ones actually making the shoes. Foot Locker would be the product market, who's merely taking the shoes that Nike produced and making them available to the consumer. On the far right-hand side of our circular flow diagram, we have the factor markets. I found that this is the one the kids tend to have the most difficulty with because the idea of a factor market's a little bit esoteric. It's not a physical place, but it's something like the labor market or the market for oil or the market for cotton. There's not one physical place that is the factor market where people go, and that fact kind of throws the kids off a little bit because the product market is a physical place, but the factor market's more of an idea. The main role of the factor market is to pull together the factors of production. They pull together the raw materials and resources that are going to be used in production and make those available for sale to the firms. So in our previous example, the Nike factory in Thailand wants to make shoes, but they don't necessarily want to grow cotton. And so they'll rely on somebody else to produce that cotton that they'll buy from them. That somebody else in this equation is going to be the factor market. Last but not least, just to skip ahead, we're going to go ahead and put the government as a sector of the economy in the middle of the circular flow diagram. Some textbooks leave government out and add it in later. I don't want to spend multiple days going back over the circular flow diagram after this particular lesson. So I go ahead and put it in there at the outset. That way I don't have to go back and redraw it a couple of weeks down the line. The government has kind of an interesting role in here. So the role of the government in the circular flow diagram is to basically redirect money and resources to places where the market wouldn't naturally put them. So we'll say that the role of government is to basically redirect money and resources in a way that benefits society. And usually I'll tell the kids that there's really two reasons why we need a government in the middle of this market to redirect resources. The first of which is that there are some products that are flat out not profitable, and that any product which isn't profitable won't be produced by the private market. And so there are some products out there that we need to have for society to function. There's not really a good way to go about making a profit with those products, and so we rely on the government to step in and actually produce those products for us. Those would be things like roads. Like there's not really a good way to make a profit on the creation of roads or bridges, but we as a society need roads and bridges to produce to move all of our goods and services through the economy. And so the government's going to step in and they're going to create those products that the free market wouldn't create on its own. The other reason we need government in here is because there are some products that the free market would produce, but would not produce at a cost that is beneficial to society. So there's some things like arguably healthcare or the postal service that certainly the free market could and will produce those services, but the cost of those services to the consumer would be higher than we as a society are willing to accept. And so we let the government step in and produce those products, oftentimes at a loss for the economy, because it's in the best interest of everybody to have low-cost access to something like the postal service. And I'll usually tell the kids, the post office sends an employee to your house to pick up something from your house. They fly it across the country. They send another employee to somebody else's house and drop it off at their doorstep for something like 54 cents. There's absolutely no way to turn a profit doing that. The private market would certainly not provide that service for under $1, but there's a societal benefit to being able to move goods and services back and forth at a low cost, and so the government's going to provide that service, operating primarily at a loss because it's in the good of society. Once the students understand what the major sectors of the economy are and basically what their function is, we then need to get started with the pairs of arrows that basically represent transactions occurring in the economy. I found that it's useful to do these kind of like one pair at a time, because I think understanding the transaction a little bit at a time makes it a little bit clearer for the students what's going on. I like to start with the transaction the kids are most familiar with, which is the households to product markets transaction, but certainly you could start this wherever you'd like. So in this particular transaction, the outside arrows are going to represent, the ones that are kind of a gold color here, are going to represent the flow of money through the economy. And what we're going to be doing as we go through this is we're going to be tracking this money as it relates to GDP. So we're going to use the circular flow diagram as kind of our introduction to the concept of GDP. So when households go to product markets to purchase goods and services, so Foot Locker in our example, if I go to Foot Locker and buy some Nikes, that spending that the households do at the product markets has a specific name. It's called consumer spending, and it is going to be represented in GDP by the variable capital C. So basically, households go to the product markets, they give the product markets money in the form of consumer spending, and in return, they get the final goods and services that they desire. In our example, shoes, but it could be anything that they're purchasing at the product market. The next major transaction that takes place in the circular flow diagram is going to be between the product markets and the firms. So keeping in mind that firms produce final goods and services, not product markets, the product markets have to get the products they sell from somewhere. And so the transaction here is basically the product markets taking some of the money they got from the consumers and giving it to the firms to restock their shelves. So they're basically receiving in final goods and services in exchange for money. I like to take a moment here to stress that the final goods and services that are leaving the firms and going into the product markets are literally the exact same thing that the consumer buys off of the shelf. The product market isn't doing anything to these goods and services other than making them available to the consumer. They're not adding anything to them. So literally, the Nike shoe that went into the product market is the same as the Nike shoe that leaves it and goes home to the households. When it comes to spending here, I like to differentiate exactly what's going on. So when product markets buy final goods and services from firms, that's what's called investment in inventories. And it's going to be represented in GDP by the variable capital I. There's going to be a couple of places on this diagram where I for investment shows up. So I wanted to differentiate this one from the others. This is investment in inventory. You may want to specify to the kids that inventory investment is when a product market buys things that they're going to resell. So all of the shoes sitting in the Foot Locker warehouse is Foot Locker's inventory. So they're spending money with the intent of getting more money back in the future, making an investment. And in this case, it's investment in something very specific, inventory for their stores. From here, the firms are going to take the money they got from the product markets, and they're going to need to reinvest that money as well in the purchasing of additional factors of production. So this is a different form of investment. This is going to be investment by the firms in physical and human capital. So they're basically purchasing labor on the factor markets. They're purchasing the raw materials used in production. And because they're spending money here with the intention of making more money, that's also going to be investment, which is also going to show up as capital I on the circular flow diagram. Now, the easy way to remember what the factors of production that they're purchasing is the acronym CEL. It stands for capital, entrepreneurial ability, land, and labor. So basically, those are the big things they're purchasing. They're going to turn that capital, that entrepreneurial ability, the land and labor, into final goods and services, which they're going to resell to the product markets. And the spending on that is investment. It's investment in physical capital and human capital. The last major transaction that's going to take place on the outside of our circular flow diagram is going to be when the factor markets then restock up on the factors of production so they have more to sell to firms in the future. And this is where households end up with the money they use to make their consumer spending purchases. So the money that goes from the factor markets to the household, primarily in exchange for labor, but also, especially if households are wealthier, in exchange for land or capital or entrepreneurship. The name of those things are going to be rents, wages, interests, dividends, and proprietor's income. Rent being payment for land, wages being payment for labor, interests and dividends, and proprietor's income are going to be payments in various ways for capital and entrepreneurial ability. So households are getting their money from the factor markets, primarily from the labor market, but not exclusively, and that is where the money they get comes from, that they can then take to the product markets and spend on the consumer goods that they want. This is a really good time to broach the subject that we're going to have to hammer into their heads later, which is that one person's spending becomes another person's income. Now that we finished the outside set of transactions on the circular flow diagram, they can see that how the money that the households spend at the product markets eventually comes back to the households in the form of rents and wages, etc. This might be a good time to talk about what happens on the business cycle when households choose to stop spending and we go into a recession. If households don't spend, then there isn't as much money flowing on the outside of the circular flow diagram, and the end result of that eventually will be households bringing in less income as well. So this is a good time to hammer home the point that one person's spending becomes another person's income, because that's going to become really important later. When it comes to calculating GDP, we're not going to add rents and wages and interest when we're doing it through the expenditures approach, which is what we're doing here. Although, if we wanted to do it through the income approach, this is basically what we would add to get there. The AP exam doesn't really ask about the income approach anymore, so we're going to go ahead and skip that. Moving to the center, I like to talk about the relationship that government has with both households and firms basically together, because it's essentially the same relationship. So the big idea here is that government is going to redirect money from households and firms in the form of taxation. So they're going to get money from the households in the form of the personal income tax and money from firms in the form of the corporate income tax. This isn't a perfect model, but it's close enough for our purposes here. So households and firms are going to give the government money, which then becomes government revenue, in exchange for the services the government provides. This is everything from national defense to a police force to creating roads and bridges and schools. And so essentially these households and firms are what fund the government's operations, and they get that money by redirecting money that would go to the households and would otherwise become consumer spending and would go to the firms and would otherwise become investment spending. They redirect that money and use them to create government services. Our last transaction for the domestic economy, at least, is going to be figuring out what the government does with the tax revenue that they brought in from the households and firms. And so they essentially do two different things, both of which are going to be categorized when we get to GDP as government spending, which is going to be represented by the variable capital G. So there are some products which the government doesn't want to produce itself. And so the government will take the money that the households and firms gave it and go to the product market to buy completed goods and services. This is anything from, airplanes to, high school textbooks. So the government doesn't necessarily want to produce all of the products it needs itself. That's just not the government's business. And so they go into the product markets and buy finished goods and services and get those goods and services back and use them for the public good. This is what's called government spending, and it is represented by capital G. On the other hand, there are some products the government chooses to produce itself, things like roads and bridges, and police force and things like that. And so the government also engages in government spending in the factor markets, where it gets back the factors of production that it will then use to produce those goods and services that the government actually makes itself. So if we're making roads, the government's not out there pulling together concrete and asphalt and labor. They're going to go to the factor market to get all of those things, but it's the government that actually makes the road. So there's some products the government makes for themselves, in which case they need factors, which they purchase through government spending. And there's other products the government chooses not to produce themselves, and they go to the product markets to buy those things already made, which is also government spending. Finally, I found that it's helpful for future lessons in this class to go ahead and introduce the concept of the rest of the world at this point. Technically speaking, you don't need to introduce the rest of the world at this point in the circular flow diagram, but when we get later on at the very end of the course to trade and the balance of payments, I found that it's good to have kind of introduced the concept to the kids before we try to do that way down the line in about 2 months' time. So the first transaction I like to talk about with the rest of the world are purely financial transactions. This is basically investment. So when money leaves our country and gets invested elsewhere, we call these financial outflows or financial capital outflows. And when people from the rest of the world invest their money in the United States, these are what are called financial inflows or financial capital inflows. Now, capital inflows and outflows aren't really relevant to GDP because these are primarily purely financial transactions and aren't going to get counted here. But they're going to be relevant later on when we do the balance of payments. And so since we're going to introduce imports and exports here anyway, I like to go ahead and introduce the financial markets. We won't mention them again for a little while, but I like to have at least given the kids some familiarity with what a financial market is. So I introduce them here, but we don't really talk too much about them beyond labeling them. The final major transaction we need for the circular flow diagram, and I know this was a doozy, is tracking the flow of goods and services in and out of our economy. So for financial inflows and outflows, we track the flow of money. Now we're tracking goods and services. When other countries purchase products that are made here in the United States, those become our exports, which is going to be represented by the variable capital X. And when we purchase their goods and services, this is going to be represented by imports, which is going to be represented by the variable capital M. Now, what we need for GDP is these things together basically tell us an important variable known as net exports, or XN. So you get net exports by taking exports minus imports. You may want to tell the kids that anytime they're given a variable that's a net number, they need to know the formula for finding that number. So net exports is equal to exports minus imports, and that this number is basically the final component we need for taking the circular flow diagram and turning it into GDP. You may want to point out that very wealthy countries like the United States oftentimes have a negative number for net exports. The US very often has a large negative number for net exports. If the net exports number turns out as a negative number, this is what we call a trade deficit or a current account deficit in the terminology we'll use later on. If you end up with a positive number for net exports like a country like China would have, this is what's called a trade surplus, or in the future we'll call it a current account surplus. So now that we have C, we have G, we have I, and we have XN, we can take this information, put it all together, and kind of hit the punchline of this entire long lesson, which is how do you solve for GDP? So now that we've actually tracked the flow of goods and services and the flow of money throughout the entire macroeconomy, I can now come up with my equation for finding GDP. It's a relatively simple equation, even though it looks a little bit scary because there's a lot of letters there. But essentially what we have is GDP, which is represented by the variable Y, is equal to C plus I plus G plus XN. So consumer spending plus investment spending plus government spending plus net exports is GDP. And we're going to do a whole lot with this piece of information, but GDP basically tells us what is the overall productivity of our economy in any given year, and it's useful as an economic indicator to gauge the health of the economy. So in a perfect world, every time we cycled through this circular flow diagram, every time money went all the way around the diagram, there would be more and more money circulating through the economy, more and more goods and services circulating through the economy. And if that's not happening, that's one indicator that there might be a problem that we can then look into as economists and try to figure out what that problem is. So GDP is equal to C plus I plus G plus XN, and that's the formula the kids will have to memorize for this. You may also want to point out right here that you can also talk about GDP per capita. So I like to use the United States and China as an example. Within the next 5 or 10 years, China's overall top-line GDP number is going to be greater than the United States. Ours has been number one basically since World War II. However, there are also roughly 4.5 or 5 times more Chinese citizens than there are US citizens. So you may want to talk about one of the limitations of looking at GDP is that it doesn't necessarily tell you how productive each citizen is going to be, only how productive the entire macroeconomy is. So if we take our GDP per capita, or per person GDP, which is taken by, you find that by taking GDP and dividing by the number of people in the economy, you'll find that even in a couple of years when China surpasses our GDP as a top-line number, our GDP per capita is still number one in the world. Our workers are certainly much more productive, and that GDP per capita number is a lot more useful for figuring out standard of living and figuring out how this number actually impacts people's daily lives. So it's good to have the highest GDP, that's nice, but it's really GDP per capita that makes a big difference in people's lives. And I like to point that out because, you know, we're looking out for number one, certainly, but eventually an economy with 4 or 5 times the number of producers will surpass ours, and it's not something necessarily to be particularly worried about. That is basically the big lesson on the circular flow diagram. If you guys are still with me at this point, we're almost 25 minutes in. I thank you for spending the time to watch it. If you have any questions, feel free to shoot me an email. You know where I am.